kids going into an ice cream parlor no longer want to eat the regular vanilla ice cream, butterscotch ice cream, or chocolate ice cream. They want to top all the three of them, layer it, add to it some chocolate drizzles, add to it some nuts and some seeds and some fruits and some more chocolate chips just to make that yummy ice cream even more yummier. So, what am I talking about over here? I'm talking about customization. Customization of financial products is a new theme in financial markets. Customization refers to non-standardization of many of the financial products. In an earlier video, I had spoken about the categories of private equity markets and public equity markets, listed stocks versus unlisted stocks. In this video, we'll talk about what are OTC markets and what are exchange markets. What is an exchange? An exchange is for example, a stock exchange is an entity that facilitates centralized trading. Okay, centralized trading means the transactions, the orders are all routed through the stock exchange, for which the brokers of the stock exchange facilitate the trade. So this is centralized trading. Centralized trading ensures that the counterparty to each of these trades is the stock exchange itself. So the buyer has no clue who the seller is. The seller has no clue who the buyer is. For them, the counterparty to the trade is the stock exchange on which the trade was conducted. So this is centralized trading, and this is a very important aspect of understanding what is anonymity in stock market trades. In stock market trades, because counterparties don't actually physically interact with each other, except for you with your broker, the seller with the broker, there is no interaction at all between the buying entity and the selling entity, largely because the stock exchange does the centralized matching of all orders on the basis of price and then of course volume. So stock exchange products are very, very standardized. If I say standardized, what do I mean by standardized? By standardized, I mean that the settlement dates are standardized. The rolling settlement is standardized. It's a T+1 rolling settlement in many markets in the world. That means if the trade takes place on today, the settlement will have to take place on the next working day. So T+1 rolling settlement or T rolling settlement is a aspect of standardization. The terms of the contract also cannot be negotiated. What do I mean by terms of the contract cannot be negotiated? The lot size, the tick size, all these things are standardized in a stock exchange contract. And therefore, stock exchange contracts have a large volume of trades, okay, which are routed through it because of the standardization. People actually like it, all right? The second aspect, as opposed to standardization, is customization. Customization refers to all the OTC products, over-the-counter products, which are designed to meet the requirements of the counterparties to the trade. The OTC markets dominated by fixed income, that is bonds, and interbank FX markets are extremely deep in terms of volumes. So a single lot size of trade in any of these markets, that's the interbank FX markets or the bond markets, could run into literally $500,000 upwards. And that makes customization very, very useful for the investors. So investors who are looking to have a customization and non-standardized products prefer to trade in the OTC markets where there are quotes that are given, QUOTES. OTC markets are markets which have non-standardized products. The products do not have centralized trading. So there is no order matching mechanism to match counterparty trades. So how do they go around searching for it? The dealer over here plays a very, very important role. They go around searching for counterparties to every order that goes onto the FX markets, onto the interbank FX markets. We now have a few trade matching systems, but that's still not centralized in terms of the market space as wide as, let's say, the stock exchange is. So OTC markets thus are quote markets, QUOTE markets, where the dealer gives bid and ask quotes. The dealer is always giving a two-way quotation. What is the bid price and what is the ask price? The price at which the dealer is willing to buy the underlying asset is called as the bid price, and the price at which the dealer is willing to sell the underlying asset is called as the ask price. The dealer gives these quotes for a certain quantity irrespective of whether they are wanting to buy or wanting to sell. On the other hand, in stock exchanges, you must always punch in whether it's a buy order or a sell order. You can't actually give a bid ask quotation on the stock exchanges. You're actually just placing buy orders, sell orders, and if the positions are moving in a haste or moving very, very rapidly, you then put in stop loss limits as well. So the OTC markets have centralized settlement but decentralized trading. But the exchange markets have centralized trading and centralized settlements. So in a trade that's conducted on an exchange, the buyer knows nothing about the seller. But in the case of OTC markets, the buyer has to know everything about the seller. They have to know in-depth details about the counterparty, because it could give rise to counterparty risk. So there is absolutely no anonymity in a dealer-driven market, in a quote-driven market, and an OTC market, because you're taking in exposures of up to $1 million plus, against each other, and that results into the markets having to compensate for that credit risk that could arise. So there is information asymmetry, okay, in the OTC markets. But that doesn't mean the buyer and the seller do not know anything about each other. In fact, they have to not only know a lot about each other, they also have to impose credit limits on each other before they can even initiate the trade, so that they cap the credit exposure or the default exposure that they could potentially have against each other. So the OTC markets are very fascinating. In fact, in the coming years, I believe clearly that the OTC markets will be more dominant than the exchange markets, as people are willing to put in capital, are willing to invest their funds for something that is more structured and more customized, rather than something that's very standardized and very off the shelf.